Hey, what's up guys? Mike the CPA here of Money and Life TV, so welcome back. I want to kind of cover with you some of the most common tax mistakes I see people make throughout the course of the year. And so that's why in this video we're covering 8 of the most common tax mistakes I see people making. And these are mistakes that are very sad but are costing people thousands upon thousands of dollars and a lot of stress. And if I can share some of these mistakes with you, I hope to help you avoid them in your personal life and personal situation. I just want to take a moment real quick to say thank you so much to each and every one of you for your support on this channel. It means so much to me reading your comments and interacting with you guys over YouTube. And as of this time, we've broken over 4,000 subscribers on this channel, and things are still growing rather quickly. So thank you so much for that. Okay guys, let's dive right into the information and cover 8 common tax mistakes I hope to help you avoid throughout the course of this year and for many years to come. Let's get started. So we're gonna go over these one by one. Please excuse my chicken scratch. But if you can't read it, don't worry, because I've included downloadable show notes in the comment section down below this video. So make sure to check them out whenever you get a chance. It's on a Word document and you can download them for yourself completely free. Because if you're anything like me, you go on YouTube, you watch an educational video such as this one, and then a couple weeks go by, a few months go by, and you're like, what did that guy say about this or that? Well, don't worry, you can download the notes for yourself and put them on your computer or in your email, cell phone, under your pillow, wherever you want them, so that you can go back and refer to them anytime in case you forget. Okay, let's start with number 1. This is the first mistake that I see people make, is not adjusting their W-4. So each and every year, people make different amounts of income. Either their income goes up or their income might go down. And the problem with not adjusting the W-4 is when one does not adjust their W-4, what ends up happening is, one, they either greatly overpay their amount of taxes and give too much money to the IRS and have to wait until they file their tax return to get it back. Or 2, even worse, they greatly underpay their tax and end up owing thousands upon thousands of dollars. Now I understand that a lot of people get tax refunds back when they file their tax return, but there's a lot of people who do not. And the more money they make, the more likely they are going to have to pay their taxes. And so I've seen situations where people don't have enough withholdings on their check, and when it comes time to file their taxes, I have to call them and tell them, hey, you owe tens of thousands of dollars in tax. And it's a very uncomfortable conversation, but I have to explain to them that their withholdings on their W-2 are just not enough, and they need to withhold more to prevent this issue in the future. So if you have a life event, like where you get married, or maybe you start doing additional or maybe you start doing like a side hustle and start making additional income on a consistent basis, or like you have children or things like that. If you have some major life events that are happening or taking place, maybe you're going into retirement, maybe you're going to, maybe you start collecting Social Security, but you're still working at your job. These are all some examples of when you might need to change your W-4 withholdings. So just keep that in mind and prevent yourself a headache when it comes time to file your taxes. Number 2 is, I want to talk to you guys about retirement distributions. So this is when a person starts to receive distributions, obviously, from their retirement account. Now this is like, let's say a person has a 401k, so they start getting distributions monthly from their 401k, or they have a traditional taxable IRA. We're not really talking about Roth IRA here, because Roth IRAs are generally tax-free when you take the income. There are some exceptions with early withdrawal penalties and things like that for Roth IRAs when you might actually have to pay some tax. But generally, we're talking about here just distributions from a taxable retirement account. Well, what I see happen is people start getting these distributions from their retirement account, and this is, especially when it's something new. This is like a new thing. In the past, let's say they haven't got distributions from their account, but now they are. So they have all this additional income coming in, and they might still be working. It is possible that they still might be working part-time or something like that. Or the other situation I see is if they're getting the check, when that person gets that check from the custodian of that, let's say 401k, for example, well, they need to look to see if taxes are being withheld on that money, because I hate to say it, but those retirement distributions, especially from a 401k or a traditional IRA, are going to be taxable. And so what I've seen happen, and it happens a lot, is people don't withhold income taxes on these types of distributions. And so when it comes to tax time, they owe, I've seen people owe thousands upon thousands of dollars. Now mind you, I've been doing taxes now for 7+ years. And so I've seen these things fairly frequently, and which is why I thought I need to make a video on this. And so if you're getting distributions from a retirement account, if a person's getting distributions from one of these accounts, they need to be speaking with that company, whoever it is, let's say it's Vanguard, Fidelity, whoever that custodian is, to make sure taxes are being withheld. Now let's move right into number 3. Let's talk about early withdrawal penalties. Okay, so a lot of people, they get desperate for money, or they need extra money to either buy a new car. Let's say they want to help out with a family event or a wedding, or help somebody pay off a mortgage, buy a house. You guys get the idea. Well, a lot of times the first thing people think to dip into, which is the worst thing you can dip into, is their 401k. So a person goes and they draw money out of their 401k, and of course they need the money, but they're not even 59 and a half. So you guys probably know what that means, early distribution penalty. And so when they get that tax statement at the end of the year, which is a 1099-R, is what I'll show you on screen here of what that looks like, there's gonna be under the code section in box 7, it's gonna say code 1, which is gonna indicate that that person took a early retirement distribution, and they're gonna have to face a tax penalty of 10% on that money. And so just real quickly, let's pretend a person, I've put it up on my little other whiteboard here. Let's say an individual, they take out $10,000 to help their child with their wedding, or some random expense that pops up for a family member, and they want to help them out. So they go get $10,000 out of their 401k. They then are hit with, because they're not 59 and a half, they're hit with a $1,000 penalty. So 10% of $10,000 is $1,000, right? But what most people don't understand is that person doesn't understand they haven't even actually paid income tax on that money just yet. That's just the penalty portion. So now they still have to pay income tax on $10,000. So then, let's say they're in the 25% tax bracket is where they land tax-wise. Well, then we have to take 25% times 10,000, and they have to pay an additional $2,500 in taxes on top of the 10% penalty. So all in all, to take out that money out of their 401k or retirement account, they end up paying $3,500 total in taxes and fees. And so it's brutal. It's brutal. No! Now, the point I want to make with these 2 examples right here, number 2 and number 3, is that if a person starts to take money out of their retirement account, please, that person should really be looking at if withholdings are being taken out of their check, and contact your CPA or enrolled agent or accountant or whomever you're working with to get a better jump on what taxes they might face with these penalties. Because I mean, if you're somebody who's doing something like this, you don't want to have to pay a huge tax bill at tax time once the money's already spent and gone. I'm sure you would much rather know about what you're going to owe ahead of time. So do some tax planning, call your CPA, and tell them what you're thinking about doing before you actually go and do it. Now, in the show notes, you're going to see I listed one alternative to taking an early withdrawal out of your 401k is actually doing a 401k loan. Because as long as you pay it back, yeah, you're going to have to pay back that 401k, but you're not going to be hit with that early withdrawal penalty of 10% as long as you pay it back within the terms of the 401k plan. So that's just something to keep in mind. All right, let's move on to number 4. And I see this all the time with large financial transactions. So a lot of people, they want to save $100. So how should I put it? I'm trying to figure out how to put this. So many people, when it comes to large financial transactions, they want to figure it all by themselves. And so they go online, they Google some stuff, or they don't even think about it at all. And they just go, and without thinking about what they're doing, they just go execute this large financial transaction. Well, what are some examples of large financial transactions? Well, it's kind of like real estate sales. So they sell their home, or they sell a rental property, or they sell let's say they have a huge stock portfolio and this person sells their stocks. Well, that person might have some large capital gains they're going to have to pay later on that they haven't considered into their normal tax situation. So once again, what ends up happening with these large financial transactions is they don't tell their accountant. Either they don't think about it or they just don't want to even pay their accountant anything. And some people, I understand a lot of people don't have an accountant or CPA, and some people do. If you don't have an accountant, that's cool, whatever. But if you have an accountant, if you have a CPA or somebody who does tax work on a regular basis, and you're about to execute a large transaction that's in the tens of thousands of dollars, shame on you if a person doesn't contact them to figure out what the tax consequences might be. Shame on them, especially if they have an accountant. I mean, their accountant's probably sitting. Your accountant guys, they want to talk to you. They want to be able to help you out and navigate through these situations. That's what they're there for. They're sitting over in the corner like a puppy, waiting to be taken for a walk. We'll call them up, take your accountant for a walk, so to speak, and tell them what you're thinking about doing before you do it. And so what I see happen all the time is people just go and do it. They don't even consult with their accountant because they don't want to pay their accountant $50, $100, whatever it's going to be, and it ends up costing them thousands. And I've seen real situations multiple times now throughout the course of my career doing taxes where if they would have just spoken to their accountant, we could have helped them reshape the transaction and saved them thousands upon thousands of dollars in tax. But they didn't want to pay the fee. They didn't want to pay $100 to get that advice or to reach out. And a lot of times your accountant won't charge you if you have a quick question. So have an accountant in your corner or CPA in your corner and talk with them before doing any large deals that are in the thousands upon thousands of dollars range, so that you can get a jump start on whatever tax implications might take place. All right, let's move on to number 5. Estimated tax payments, real quick. So some people have a requirement to pay estimated taxes. And a lot of these people are usually business owners or people who make their living as a self-employed individual. So let's say they have their own landscaping company, they do consulting, things like that, just to give you guys some example. Well, they obviously might not have a normal paycheck or W-2. And so every quarter they're required to pay tax estimates. And so many of these individuals, they will go to a CPA, and especially because business tax is a little bit more complicated than just normal run-of-the-mill, just make wages and have a W-2. So it gets a little bit more complicated. So a lot of times the CPA will, after they're doing their taxes, they'll suggest, hey, Mr. Business Owner or Mr. or Mrs. Business Owner, we suggest that you make these estimated tax payments throughout the year. And it's usually once a quarter. So one in April, one in June, one in September, and one in December or January, depending upon when they want to make that payment. And what happens is a lot of times people are like, nah, I don't need to pay those, or nah, I don't really think I need to do that. So they avoid paying those, they miss those estimate payments. So if a person has not paid in enough quarterly throughout the course of their year for their estimated tax payments, they might be subject to underpayment penalties. And on top of that, they might have to pay interest as well for money that they should have paid, but they didn't. So a very common and easy mistake to fix is if you have estimate payments or suggested estimate payments and your CPA gives those to you, make sure you're making them, or have a reason that you're not making them. Maybe your tax situation's changed where maybe you no longer need to make them, but just keep that in the back of your mind and make sure that you're following up with your accountant on this to make sure you're not going to owe even more tax at the end of the year because you're not making these payments. Let's avoid penalties as much as possible. I hate when I see people pay penalties when they don't have to. It drives me crazy. All right, let's move down to number 6, extensions. Let's talk about extensions and late filing. Okay, I understand that not everybody can pay their tax bill on April 15th if they owe taxes. But what I see happening is that a lot of people, they decide, oh, I'm not going to even file. I don't want to file. I want to make sure that, I can't pay my taxes right now. I don't want to file, let the IRS know how much I owe them. It just makes it so much worse, and it's such a big mistake to make because the IRS understands that you might not be able to pay all your taxes on time, but the person will do themselves a great disservice if they don't file an extension. If a person knows they're going to be filing in a late, then that person, I would really recommend to them, file an extension. And I'll tell you why here in just a second, because filing an extension is going to give you from April 15th all the way to October 15th or even October 17th to file that tax return. And what it does is, let's say that person then extends their tax return and then works up their tax return and figures out they owe money. Ah, shoot. Well, they can't pay it all, right? But there's going to be some penalties and interest because they can't pay it all. However, the meanest, or one of the meanest penalties they can face is a late filing penalty. See, the IRS has penalties for late filing, late payment, and things like that. So, but the late filing penalty is brutal. So if the IRS sees that you did not file your tax return, they're gonna charge you 5% per month. Oh yeah, per month, 5%. How's that for an interest rate for you? If on the amount of taxes that were not paid. So if a person owes them $10,000, well, that means that a 5% penalty is gonna be what, $500, right? So it's very costly to not file your taxes on time. And the easiest way to avoid that late filing penalty is just make sure you have an extension in place and get your taxes filed timely. And like I said, that person might still be subject to some penalties, but it'll still save them a lot of money in the long run. Number 7, oh, this is a fun one. Ignoring the IRS. Oh, brother. What happens is a lot of people will get, if a person gets a tax notice, sometimes they'll ignore it. They'll get a tax notice in the mail from the IRS, and they're like, I don't want to deal with this. I'll just ignore this right now. Or they won't file their taxes, or whatever it may be, whatever the situation is. But the IRS is not somebody you can run away from. If you guys have seen that movie, if you guys have seen the Halloween classic Halloween, if you guys know Michael Myers, you know who I'm talking about, one of those 80s slasher films, the IRS is kind of like him, where they're relentless. They're gonna keep coming for you over and over again. And so if you get a tax notice in the mail, then what a person needs to do is respond to that notice as quickly as possible. Now, I'll tell you from experience that half the tax notices I see are bogus. And by bogus, I don't mean they're fake. They're real notices, but the IRS has mixed up somebody's records. The information on the notice is wrong. The amount of tax due on the notice is wrong. But the thing, to get that to stop coming in the mail and to get the IRS off your shoulders, because the IRS is like a gorilla on your back, you just need to respond to that notice in writing and look at what they're asking for, what the notice is about, etc. And if you do get a notice, definitely you might go to a CPA to help you with it, just to get the IRS off your back. Because if a person doesn't respond to that notice and if there's an amount due on that notice and they don't pay it, then you start with responding first. You don't have to pay it right off the bat, but what's going to happen is a month is going to go by and that person's going to get another notice. And the next notice they get, when they open it up in the mail, I can guarantee you one thing: the amount that they're going to owe is going to be more. There's going to be more penalties and more interest on it. And if they wait 2 months to go by, guess what's going to happen? They're going to open up that notice in the mail, and once again, they're going to owe even more, and there's going to be more and more penalties. And so we can't ignore the IRS, even though we want to, even though we want to hide under our pillow, we just can't. The only way to get them off your back is to face them head on. Just like with Michael Myers, you have to face him head on to get rid of him, because the IRS is relentless and they're going to keep stalking you until you've satisfied them. They have unlimited power. They are very powerful, and you do not want them as a creditor who is after your paycheck, because they can garnish your wages and just create a whole bunch of hassle and doo-doo in your life, and you just don't want it. Number 8, last but not least, one of the most common mistakes I see is bad record keeping. Now, I know that this is kind of common knowledge of having good records, right? We talk about having good records. Keep good records. But what people don't always understand is that if they are ever audited, the main thing that will save them from an audit is having good records. And so I think the idea of having good records is highly underplayed. The value of having good records is very substantial. Having written records, having receipts, documentation to prove what a person's trying to do is very, very beneficial. And if that person never gets audited, they're going to have a strong chance that they're going to be able to fend off the auditor, because they'll have the receipts to prove their deductions and so forth. Now, in tax court cases, I've read quite a few tax court cases in my day now, working as a CPA for over 7 years. If you read a lot of tax court cases, what you'll find is the ones that are won, the ones where the taxpayer wins over the IRS, it's usually because they have substantiation. They've kept good records, good receipts, and they can prove that their position, their tax position they were taking was totally legitimate, and that they have a reason for the deduction, and usually the courts will side in their favor if that's the case. So I just wanted to share these with you guys, these 8 common mistakes. Please, the overall idea here, guys, is to not just think about taxes just from January to April 15th. No. We want to just think a little bit, at least a little bit, about our taxes and our tax situation throughout the year, so that we're not greatly overpaying them or we're not greatly underpaying the IRS, because that can just lead us to a whole bunch of heartache. And I'll tell you, in my profession, there's nothing more disheartening for me to have to call a client and tell them they owe thousands upon thousands of dollars. And I mean like tens of thousands of dollars, okay? I'm not talking about like 1,000 or 2,000. I'm talking about like 20, 30, 40, 50, 60,000. I've had phone conversations like that. It's very uncomfortable. But you know what? They didn't tell me. They never once told me that like this stuff is going on. So your accountant your accountant's no good if we don't tell them what's going on. If a person doesn't communicate with them, these types of large financial transactions or these other things with their accountant, because once the end of the year comes, it's too late. You can't change it, and the accountant can't do anything for you at that point. It all has to be done beforehand, which is why tax planning might be something you consider depending on what you have going on in your circumstances and in your life, especially if you have more income coming in, or if you're going to be doing some large real estate transactions, things like that, or starting to take retirement distributions. All these things, guys, are reasons to talk to your accountant, or at least be thinking. If you don't want to contact your accountant, that's fine, but at least be thinking about these things and how it might impact your taxes and how much you might owe when it comes time to actually file your taxes on April 15th. So I hope you guys found this information helpful. I know that if you do these things, if you pay attention to these things, it will save you so much stress. Rather than holding and praying, saying, oh, I hope I don't owe, I hope I don't owe, it will just give you a jump start ahead. So you don't spend all the money you make with these things ahead of time, so that you can actually pay the tax when it comes due if you owe tax at the end of the year. All right, guys, I'm going to start wrapping up the video right here. Remember, if you're somebody who wants to learn more about finances, more about taxes, and more about investing, here on Money and Life TV, we make new videos every single week that cover those topics. We also make some additional videos on career-related videos, as well as life-related videos as well. But our main focus here is teaching finances, investing, and taxes on a weekly basis, so you can improve your financial position, your career, and your life. If that is something you want to learn more about, then I would highly suggest you hit that red subscribe button down below so you do not miss any of our future uploads. Now, it would just mean so much to me, guys. If you enjoy the video, please help me out by hitting that like button down below. It lets me know you like this video and you might want to see more stuff like this. If you have questions or comments, please drop them in the comment section down below. I imagine you might have some questions on this kind of stuff. These are just some of the things, common mistakes I've noticed that I've seen people make on a normal every yearly basis or on an annual basis, and that these are things that I think people could easily avoid. And obviously, if you have somebody in your family who could benefit from this, please share this information with them. You can share this video with them by hitting the share button down below in the video link section, or right below the description section of this video. And like I said, don't forget to download the show notes so you have them. Thank you so much for spending time with me here on YouTube. As always, it is such a blast hanging out with each and every one of you. And I hope you have a fantastic week. I hope you found this information helpful. All right, guys, I've spoken your ear off. I love y'all. Peace.